Hey, good morning, everyone. Welcome back to Paycheck to Portfolio. Hope you're having a great 4th of July with your family. This morning, I wanted to talk about how I use margin as a disciplined business tool. You can see the quote by Robert Kiyosaki above. He says, leverage is the reason some people become rich and others do not become rich. We'll walk through this step by step. Let's do a portfolio update, then we'll jump right in. Okay, looking at my net account value, I'm sitting basically at $210,000. You can see just my straight equity gain is about 10.5% or $43,000 of just pure equity growth. This does not include any trailing dividends or any future dividends. Future dividends in E-Trade you can see under the estimated income tab here. Friday was a decent day in the market. The portfolio was up $1,300. You can see my available for withdrawal sitting right at $13,000. When I swipe my E-Trade debit card or I pay my mortgage with my ACH transfers, it pulls directly out of this amount, which is calculated under this margin tab here, which we're going to talk about today. While fully living out of my brokerage account, looking at the historical values, you can see over the last 2 years, I'm up $110,000. If you're new to my channel, all of my income comes into the brokerage. I invest into what I reference to as 3 buckets: long-term growth stocks and ETFs. That provides me an equity base that grows over time, which I in turn can borrow against. Closed-end funds such as Cornerstone. Cornerstone pays an 18% dividend, drips that dividend down at their net asset value, which allows for additional expedited compounding. And then high yield funds, which pay dividends, such as QQQY, which is a covered call fund ran by Defiance on the NASDAQ. It pays a 30% dividend. And then QQQI, which is a high yield fund by Neos ran on the NASDAQ, which pays a 14% dividend. With all 3 of those buckets, what I get is equity growth, appreciation, and cash flow, just like a business structure would look like. Over the last 1 year, you can see again, while fully living out of the brokerage account, I'm up $81,000. So over the last 2 years, we've taken a trip to Japan, a family of 6, spent quite a bit of money. This year, we went to Alaska on a cruise with my family. So we're actively living out of this account. It's dynamic. While fully living out of it, again, you can see the portfolio is actually growing. Looking at the estimated income tab, currently over the next 1 year, you can see that the portfolio is projected to bring in about $47,000 of dividends. Over the next 1 month, currently, it's about $4,000 of dividends. Now, this number will ebb and flow. I don't get caught up too much on E-Trade's projections. Sometimes this is higher, sometimes this is lower. Basically, covered call funds pay out distributions based off of volatility and how much premium they're making. What E-Trade does is they take the last distribution and they annualize that out over the next 12 months. So some months this is going to be higher, some months this is going to be lower. I average between $40,000 and $60,000 of dividends a year. Each time my paycheck comes in and gets fully invested, it snowballs on itself as well, and it's incrementally increasing over time. What I care about is that this number covers my margin interest rate costs. And for the month of June, I brought in about $4,000 of dividends and paid out $1,000 in margin interest, which gave me a net $3,000 of cash flow on my own earned income. Let's jump into the margin tab here. So the margin tool in E-Trade is a really good, effective tool. If you think about your brokerage like a piece of real estate, it makes this a little bit easier to understand. If you've ever invested in real estate, you can borrow from your equity. Some people do that with a home equity line of credit. Some people do that with a cash out refinance. I invest into real estate pretty often. I have a wholesale real estate business and a background in private equity, but basically I bought my home I live in as a foreclosure many years ago for about $190,000. I live in a place that's appreciated in value quite a bit. Now the market's pretty cool right now across the country, but my home's worth about $500,000 now. So I can go to the bank and I can pull out 80 to 85% of what we call a loan to value ratio. And the brokerage is pretty much the same way. So if you look at some holdings down here, just for some examples in my portfolio, AAAU is physical gold ETF. You can see right now on this, the margin maintenance is 30%. What that means is if I invest $1,000 into AAAU, the brokerage is only going to lock up $300 of that equity that I can borrow against. This is straight Amazon stock. You can see also 30% margin maintenance requirements. This is AMSI, a covered call fund ran by YieldMax on Amazon. You can see it's 50% margin maintenance. So again, if you bring in $1,000 and you invest it into AMZ, the brokerage is going to lock up $500 of that equity as opposed to $300 on a 30% margin maintenance name. And then anything Bitcoin related, this is BTCI, which is a covered call fund ran by Neos on Bitcoin. You can see that's 100% margin maintenance. So if you bring $1,000 in, they're going to lock up $1,000 of your equity. At the end of the day, what E-Trade does is they take this calculator and they roll up all of my margin maintenance requirements. So right now they're saying we're not going to lend you any money on $175,000 of your maintenance requirements based off of the roll up percentage here. You have 213,000, almost 214,000 of equity. Therefore, you have excess of almost $40,000. For most people, this number is going to be within a couple $100 of this number. I have some cash secured puts on. Cash secured puts, I basically sell puts on shares I want to own anyway to get discounted pricing on those and to get paid a premium to wait. So some of my capital is tied up in cash secured puts on stocks I want to generate income on and I want to own at the same time. And those are out till January of 2027. Specifically on BITX for me personally, I'm selling a couple cash secured puts on BITX, which is double leveraged Bitcoin. You got to be really careful with that and really wise with those type of plays. And NVIDIA, which is a covered call fund on NVIDIA. So, but that's how you calculate basically your maintenance excess and available for withdrawal. People kind of get caught up in their minds about we're so used to checking account living. So we think a dollar comes into the checking account, a dollar goes out of the checking account, and it's a 1-to-1 ratio. Leverage and margin don't work that way. If you bring $1,000 in, 30% margin maintenance, your buying power goes up exponentially because you can borrow from that new equity, which continues to accumulate. And then it's only locking up a certain amount of your money, which in turn you can live off of, which is exactly what I do. So I hope that that helps seeing the visual in my actual brokerage account. Let's jump back into the slide deck and go through this in a little bit more detail. So what is margin? Margin is borrowing against your portfolio's value to deploy capital, just like we talked about in the actual brokerage. So margin is basically a loan from your broker or a line of credit secured by the assets you already own. A lot of people get confused on this topic as well, so I'm trying to hit on all the margin topics that I typically get asked questions about. I use regular T margin. That's standard margin available to all investors. Basically, we talked about the maintenance requirements. Usually long-term growth stocks are 25 to 30% maintenance. 30% maintenance on E-Trade, Fidelity, Schwab. Robinhood will typically put these at 25% maintenance. Basically, there's simple, transparent rules that you can go look up online about regular T margin. And basically, there's no special minimums other than you need a $2,000 account minimum to have a margin-enabled account. If you've been following my Spark to Fire series that I opened up for my 18-year-old daughter who's about ready to go off to college, I opened up her account with $2,500. We've been investing $250 every 2 weeks, fully deploying that and then borrowing from that equity to live off of. As she gets ready to go to college here, I'm going to pay her tuition out of that as well. So at the end of the day, she doesn't come out with a whole bunch of student loans. She's going to come out with a whole bunch of equity at the end of her education. And then there's portfolio margin, which people oftentimes mix up with what I'm doing. I'm using regular T margin. This is basically a risk-based model. It's more complex. Think about it like an old-fashioned loan. It's lower maintenance. Lower maintenance isn't always better, by the way. You can over-leverage yourself and get caught in a really bad position. But this can be as low as 15%, but again, very volatile. It requires a $100,000 account minimum. And then requirements shift with market conditions. So again, I use regular T margin. I'm not using portfolio margin. So why do most people misuse margin or afraid of margin? I get a lot of people that I talk to that seem to think margin is this taboo idea, but yet folks will go out and they will go buy a $100,000 vehicle that depreciates immediately the minute you drive it off the lot. And then 5 years from now, basically, you have to go repeat that over and over again, and people are completely fine with that because that's our culture. Same thing with a home, right? If you think about it, you go buy a $500,000 home, the bank will only make you put 3.5% down for FHA financing, 10% down, or 20% down for conventional financing. And so, we're using margin. In the American culture, we're very used to consumer debt and we're very comfortable with it. But for whatever reason, when we think about margin in a stock brokerage, we get scared, but we're perfectly fine swiping a credit card. And it's really just the way that we're trained, I believe, in our country to be consumers instead of business owners. So here's why most people misuse margin. You have the gambler, if you will, how most people use it: day trading and speculation on momentum plays, leveraging in the meme stocks with no thesis, no plan to cover the borrowing costs over time. There's no business structure, over leveraging with no safety net in place or no hard rules, and treating it like free money, and then margin call will basically liquidate you. The way I treat my portfolio is like a CEO or a CFO of a company. So how Paycheck the portfolio uses margin is I'm deploying into income generating assets with predictable cash flow, as well as the three buckets that give me equity growth and cash flow. The cash flow covers the cost of the borrowing expenses, so I'm creating a positive spread for myself. Again, for the month of June, I brought in $4,000 of dividends, paid out $1,000 in margin interest. My equity is growing over time, which I showed you in my historical values tab. So I'm using this like an SBA loan, a small business loan, to grow my equity over time. I'm using conservative ratios with built-in maintenance buffers. So for me, I'm keeping 50% equity at all times. I'm keeping put options on, as you can see, is the next bullet to protect my portfolio against a market correction or market crash. You can go check out the market crash cheat code and the market crash cheat code revisited on my channel. And then when equity grows, my debt's also shrinking as my dividend snowball increases paycheck after paycheck, week after week, month after month. And I'm managing that like a balance sheet and a way a business would. So how I use margin inside the paycheck to portfolio: I'm strategically borrowing. I'm accessing capital at a low negotiated rate. For me, it's 5.49%. I'm targeting deployments into the three buckets, but more importantly, in this specific topic, the cash flow is servicing the debt. So every paycheck that comes in, I'll get paid this coming Friday. I'll have about a $5,100 paycheck. Just for easy math, I'll have about $2,500 that I'm aiming to go into growth and closed-end funds for equity building. And then I have about $2,500 that I will be investing in the high yield funds with a targeted blend. I'm aiming for about 20%. So if you can picture it, this 5,100 comes in, I'm generating 20% yields off of half of that, and that is going to snowball into my dividends, which is going to service my margin interest rate, which gets you to number 3 here, which is self amortization. So the portfolio's cash flow exceeds the borrowing costs, and that's the whole point, and generates more cash on cash returns on my own money that would have been consumed otherwise. So in this case, margin is managed exactly like a business line of credit, except I'm acquiring assets that are growing and throwing off cash flow instead of just paying, say, labor costs. Sometimes a business will go get a loan to make payroll or to pay, depreciating assets. I'm taking this and I'm buying businesses, buying cash flow, and generating asset accumulation. So comparing and contrasting margin versus consumer debt, obviously not all debt is created equal. On the consumer debt side, you're buying depreciating items, cars, electronics, things you consume, right? Cash flows negative, it drains monthly income, and the purpose is to consume. We're very, very comfortable with this in our culture. We don't question this at all. We just think it's part of normal life. On margin debt or capital investment, I'm buying appreciating assets, equities, funds, part of companies. Cash flow is positive, it pays its own interest costs. and it's working capital. So when you look at average borrowing costs, a credit card is 24%. 25% higher depending on some of the cards. A personal loan can be 12%. My negotiated rate in Paycheck to Portfolio is 5.49%, and I'm creating that positive cash flow spread for myself every cycle. So margin is working capital. It's reframing the tool from a personal debt to business leverage perspective. And again, I'm using my background in business to try to articulate this, but traditional businesses, they'll go out and get an SBA loan or a business line of credit. They invest that into operations, inventory, equipment, expansion, those type of things. In turn, that creates revenue that pays for the debt and yields profit. This is exactly how every business manages their finances and their balance sheet. So in the Paycheck to Portfolio system, you're the CEO, you're using that margin loan or portfolio line of credit, regular T margin. You're buying assets with your full income. So your W-2 income normally gets consumed. Instead of consuming that, you're bringing the full amount into your brokerage. What your dividends don't cover, you're using margin to live off of, but you still own those assets, which generate cash flow and will break you free from a 9-to-5 job in, say, 5 to 7 years versus the normal 30-year time frame. So to me, margin isn't a gamble, consumption is. It's working capital for your own equity machine. So we talked about the cash flow spread, but I just want to put it on paper for you to see. If I'm earning 15 to 25% blended yields and my borrowing cost is 5.5%, I'm creating 9.5 to 19.5% net spreads each cycle. So the average blended yield is about 20%. My margin costs are a little over 5. So I'm getting roughly 14, 15% yields on my own cash. And what I would tell you is margin interest rates are highly negotiable. In our community, there's a lot of tips on how to negotiate your margin interest rate, no matter which brokerage you're using, but these are highly negotiable, and I recommend you check that out, and all of the resources are under my pinned comments in all of my videos. So sometimes, again, people will get caught up in you're just moving money around. Wouldn't it be better to just invest the leftovers? Because we're so trained and we're so conditioned just to think like we're living out of checking accounts, and we're not. Let's say you earned $5,000 from your W-2, you spend it on rent, food, lifestyle, it's gone. It's consumed. You spend it to zero. You got to go through that vicious cycle of trading your time for money. And then next month you start all over again at zero. So you've created zero equity and zero future income. If you've ever watched the show Shark Tank, there's a reason that they want equity in the company because they get long-term ownership of that company. If you're ever offered equity in a company versus being a W-2 or hourly employee or a salaried employee, take it, because obviously as that company grows and expands, you get access to that equity, which is a lot more money than being paid hourly and going to zero, which is the whole point. And then with Paycheck to Portfolio, if you fully invest 5,000 from your paycheck, once you earn that 5,000 from your full-time job, it enters the brokerage. It will pay down $5,000 of your current margin balance. Your debt drops by $5,000, raising your equity 5,000 immediately. Your assets are earning 20% yields on each cycle, and temporarily your interest drops, but you get 5K of instant equity. You get $1,000 a year of income plus appreciation with a 20% yield approximately right in there. You get the point. But again, when you invest that new equity into new assets, it's not locking up that $5,000 dollar for dollar. Again, we talked about 30% margin maintenance names, 50% margin maintenance names, and 100% margin maintenance names. So this $5,000 is actually times a multiple based off of what you reinvest that equity into. It's not dollar for dollar. I hope that that's been clear this entire video, because I get this question pretty often is people just think we're moving money around and we're not. We're bringing capital in just like a business. We're investing that capital, which increases our equity and cash flow. And then we're able to borrow from that capital at 30% margin maintenance, 50% margin maintenance, which allows us to live off of it, just like a piece of real estate, just like every business structure basically runs. So just to show this another way, $5,000 enters the brokerage, pays down margin, increases your equity. If you invest into a 30% margin maintenance position, $1,500 of that is going to be locked up. $3,500 is still available and free. Again, you've stretched that $5,000 by a multiple there. And then 50% requirement. Again, I don't have any problems investing in the 50% requirements at all, but you can see it's 2,500 and 2,500. So with the 30% margin maintenance name, you're freeing up $3,500, or 70% is still free, and your requirement supports 1,500. Again, you can see this on the 50%. You've opened up $2,500 or 50%, and your required support is 2,500. Either way, your equity grows by the full 5,000. The margin requirement only determines how much borrowing capacity that new equity can support. But as you can see, it's stretched further. It takes your dollar and stretches it further, whether it's 70% or 50% with these margin maintenance positions. Equity creates wealth. Margin is just a tool. The disciplined use of margin accelerates your path to true ownership. Build your portfolio like a business. All of my resources are available under all of the pinned comments and all of my videos. You can join our private Discord and membership. With the Discord, you get access to the Paycheck to Portfolio Training Academy, which gives you structured course and education, as well as AI chat agent in there you can talk to. And then you can connect your brokerage to our live Paycheck to Portfolio web application, which looks like this. I have Emma's Spark to Fire account pulled up here. You can see right here, it has all of her positions, the paper gains and losses, the total return. You can click on each one of these and it will show you the dividends that have rolled in and get added back into the total return. Dividend tracking basically on the accounts. But what I wanted to show you is the spread in an actual account. Since I have Emma's Spark to Fire account up here, you can see for the month of June, she brought in about $100 of dividends in her starter account. And under the transactions tab on margin interest, she paid out $24 basically in margin interest. So we're creating that cash for her as an 18-year-old going off to college that will snowball on itself. And that's the whole business spread we talk about. I hope you found this video useful. Please like and subscribe, and we'll talk to you Wednesday to give an update on Emma's Spark to Fire account. And we'll talk to you soon.